Hi. One of the most difficult multiples to apply when trying to calculate a target price is the enterprise value to EBITDA multiple. And the reason is because the stock price is buried within the formula for the enterprise value, but I'm going to show you a way to easily get it out using a spreadsheet I've created. But first we need to take a look at a little motivation for using this multiple. There was a paper published in the Journal of Portfolio Management, and it was written by Wesley Gray and Jack Vogel. The title of it was Analyzing Valuation Measures, and this was published in 2012. So let me give you the summary associated with this. They look at the various metrics, some of the most popular metrics, and find that the EBITDA to total enterprise value multiple, essentially it's just the enterprise value to EBITDA flipped. This has been the best performing metric historically, and quote, it outperforms many of the investor favorites like the PE and the free cash flow to enterprise value, as well as the book to market ratio, which is a favorite among academics. The other big conclusion associated with their study is that long-term ratios add little investment value over standard one-year valuation metrics. And when they talk about long-term ratios, specifically they're referring to calculating a measure of profitability over a long period of time, like averaging earnings over 5 years, 10 years, as opposed to looking at earnings over just the last fiscal year or the last 12 months. That's what they're referring to by a one-year valuation metric. So in the paper, they analyzed stock prices and returns from 1971 to 2010, and they found that the EBITDA to total enterprise value is the best valuation metric relative to others. By annually rebalancing an equalated portfolio of high EBITDA to total enterprise value stocks earned a return of 17.66% per year, and more importantly, it had an alpha of about 3%. And they calculated this alpha by adjusting for the standard three factors: size and book to market. How did that 17.66% return compare to other metrics? Well, a cheap earnings to market price portfolio provided a 15.2% return, and when you looked at the book to market portfolio, it basically provided a 15% return. Neither of these had alpha. So this total enterprise value to EBITDA multiple really does a nice job of providing a good return. So I won't bore you with the details of the study. You can certainly download it to the University Library website. It's again published in the Journal of Portfolio Management, but you need to know the two main conclusions associated with this. Enterprise value to EBITDA turned out to be the best performing multiple over this time period, and the second big conclusion is they found that, for example, looking at earnings over a number of years added very little value over a simplistic measure of just taking earnings over the past year. So why do something complicated when it adds no value? And so you should have a bias towards just using a short-term measure of earnings, like over the last 12 months or the last fiscal year. So how do we define enterprise value? The basic components of enterprise value are the market capitalization of the stock, and that generally is the current stock price times the number of shares outstanding. Then we subtract out cash and short-term investments, assuming basically those aren't needed for the current operations. We add total debt, we add preferred equity, and then we add total minority interest. Here are some of the complications associated with this, and I want you to understand the concepts of why we're either adding or subtracting some of these. First, why is cash subtracted? Well, enterprise value is designed to measure the net price that an acquirer would pay for the core operations of a company. And assuming that you could take this cash and short-term investments and they're not needed for the core operations of the business, an acquirer could just borrow money to buy the company and then use the cash that the company has, that target has, to repay the loan, and it would lower the net price that the acquirer was paying to buy out the firm. People often ask why minority interest is included in the enterprise value formula. Minority interest occurs on the consolidated financial statements of a parent company that owns more than 50% but less than 100% of a subsidiary. In other words, they have effective control of the subsidiary, but they don't own 100% of it. They don't own all of it. Essentially what's happened is another shareholder of this subsidiary has provided financing for the parent company's control of the subsidiary. And when the parent company has control, the financial statements are consolidated. The subsidiary's assets and liabilities are included on the financial statements of the parent. And when this is the case, this financing is basically represented on the financial statements of the consolidated parent statements as minority interest. And this is essentially just another form of financing. Equity is a form of financing. More equity increases enterprise value. Debt is a form of financing. More debt increases enterprise value. And when there's more minority interest, that's also a form of financing, so that increases the enterprise value. So let's take a look at the formula for enterprise value. And in particular, this top formula is relating the justified enterprise value to EBITDA ratio to the following. The price times the shares outstanding. That's of course the market capitalization. You're subtracting off cash, you're adding debt, you're adding preferred equity, and you're adding minority interest, and then you're ultimately divided by EBITDA. Of course, EBITDA is the earnings before interest, taxes, depreciation, and amortization. What is this formula really relating? Well, when you analyze a stock using relative valuation, what you do is you develop a set of peers, and you're assuming that those peers are appropriately priced, and the stock that you're analyzing is most likely not appropriately priced. Using those peers, if you decide this is the best multiple to use, then you take the multiple from the peers, and that is your justified enterprise value to EBITDA. You're saying that the company that you're analyzing should trade for the enterprise value to EBITDA of its peers. And that means that this should equal the enterprise value divided by the EBITDA of the company that you're analyzing. So you take that justified multiple and you set it equal to this. Well, that doesn't give you the target price. You have to solve for this price that's within this formula. But here I've done it for you. The target price is going to be equal to that justified ratio times EBITDA plus cash minus debt minus preferred equity minus minority interest divided by shares outstanding. All I've done is just use algebra to solve for this price right here in this formula. So in another video, I'm going to show you a spreadsheet that is going to calculate the target price based on this formula for you to make it a little bit easier for you.